Most term life insurance policies expire worthless, but not all of them have to. A term policy can often be sold. This video is educational. It is not financial, tax, or legal advice. Citizens Life Group is a licensed life settlement brokerage. It is not a life settlement provider and does not buy policies. Reviewed by Cole Hallman, Florida License 0266. Two things decide whether a term policy sells, whether it can be converted to permanent coverage, and whether the insured's health has changed since the policy was issued. A term policy that carries a conversion privilege can be converted to a permanent policy, then sold on the secondary market. A term policy without that privilege can sometimes still be sold, but only when health has declined meaningfully and enough of the level term remains. Term life differs from permanent insurance in one way that matters here. It has no cash surrender value. A whole life or universal life policy builds a cash value the owner can surrender for. Term builds none, and if it is outlived, it pays nothing. That is why most term policies simply expire. When a term policy does qualify for sale, anything a buyer pays is value that would otherwise vanish. The right to sell is settled law. In Grigsby v. Russell, decided by the United States Supreme Court in 1911, the court held that a life insurance policy is personal property its owner can sell. There are two paths. Path 1, convert a convertible term policy to permanent coverage, then sell it. Path 2, sell a non-convertible term policy after a significant health decline. Path 1 is the common route. A convertible term policy includes a contractual conversion privilege. That privilege lets the owner convert to permanent coverage with no new medical exam and no new health questions at the original health rating. Once converted, the policy is permanent, it has a cash value, and it can be sold like any other permanent policy. Path 2 is less common, but real. A non-convertible term policy can be purchased outright when the insured's health has declined meaningfully since the policy was issued and enough of the level term remains. The remaining level term has to exceed the buyer's estimate of the insured's life expectancy because the buyer keeps paying premiums until the insured's death and needs the coverage to stay in force. The Illinois Department of Insurance, in its consumer guidance on viatical settlements, states that providers can buy almost any type of life insurance policy, including term, whole, and universal life. Life settlements are regulated state by state. State insurance departments, such as the Texas Department of Insurance and the New York Department of Financial Services, oversee these transactions, guided by the National Association of Insurance Commissioners, Viatical Settlements Model Act, and the National Council of Insurance Legislators Life Settlement Model Act. Age matters on both paths. A standard life settlement generally requires the insured to be at least 65, and most closed transactions involve insureds in their 70s and 80s. Under 65, qualification usually requires a serious or terminal illness handled as a viatical settlement. The conversion deadline is a hard cutoff, often age 65 or 70, after which the right to convert disappears for good. Conversion deadlines take three common forms. The first is a specific age, often 65 or 70. The second is a set number of years from the policy's start date. The third is a cutoff before the level premium term ends. Whichever form applies, once the deadline passes, the conversion privilege is gone, and with it the most reliable path to a sale. The insurer has to honor a timely conversion even if the insured's health has declined. That is what makes the privilege valuable. Someone whose health has changed since the policy was issued can still convert at the original rating, and that health change can raise what buyers will later pay for the converted policy. One step is worth taking while the window is open. Ask the insurance company for the conversion deadline in writing. The deadline is specific to each policy. It is not something to estimate, and confirming it in writing is the difference between keeping the option and losing it. Convert and sell takes 4 steps. Find the conversion deadline, pre-qualify the policy, convert it, then let buyers compete. Step 1 is finding the deadline and getting it from the insurer in writing. Step 2 is the step most sellers skip, and it matters most. Pre-qualify the policy before converting. Conversion raises the premium substantially. According to Conning's 2025 Life Settlement Strategic Study, permanent premiums typically run 5 to 15 times higher than term premiums after conversion. A licensed broker can estimate whether the converted policy is likely to attract offers before the owner commits to those higher premiums. Converting first and asking questions later is how a person ends up paying a much larger premium on a policy that may not sell. Step 3 is the conversion itself. The owner exercises the privilege, the insurer issues the permanent policy at the original health rating, and no new medical exam is required. Step 4 is the competitive sale. A licensed broker shops the converted policy to multiple institutional buyers and presents every offer in writing. Under Florida statutes, Section 626.9911, subsection 11, a viatical settlement broker represents only the seller and owes the seller a fiduciary duty, no matter how the broker is paid. That is why the broker runs the offers against each other rather than accepting the first bid. The timeline runs about 60 to 120 days from first call to funds because the conversion paperwork is the long pole. Once an offer is accepted, most settlements close within 30 to 60 days. After conversion, a term policy typically sells for 10 to 25% of its face value, roughly 20% on average. On a $500,000 policy, that range is roughly $50,000 to $125,000. The figure depends on the insured's age and health, the premiums the buyer will keep paying, and the competition among buyers. Term is quoted as a percentage of face value, not as a multiple of cash surrender value, because term has no cash surrender value to multiply. That absence is actually an advantage for the seller. With a permanent policy, the surrender value sets a floor that anchors the comparison downward. A term has no floor, so the entire payout is money that would otherwise be lost when the policy expires. For market context, Citizens Life Group's review of the Life Insurance Settlement Association's 2025 annual market data shows that in 2025, association members paid consumers $626.6 million across 2,955 settlements, up 9.48% over the prior year. Consider two illustrative examples, both hypothetical. Margaret, age 73, converts a $500,000 term policy after a heart diagnosis, and buyers compete for the converted coverage. Robert, age 76, sells a policy he no longer needs once his mortgage is paid off. Individual results vary, and not every policy receives an offer. For a term policy, proceeds up to the total premiums paid come back tax-free, and anything above that is capital gain. The reason is specific to term. A seller's tax basis is the total of the premiums paid. After the Tax Cuts and Jobs Act of 2017 added Internal Revenue Code, Section 1016, A, 1, B, that basis is no longer reduced by the cost of insurance charges, a change the Internal Revenue Service confirmed in Revenue Ruling 2020-05. Because term has no cash surrender value, there is no inside buildup, so the middle tier that taxes part of a permanent policy sale as ordinary income does not apply. Proceeds up to total premiums paid are a tax-free return of basis. Any amount above that is long-term capital gain if the policy was held more than a year. That framework traces to Revenue Ruling 2009-13. Sales are reported to the Internal Revenue Service on Form 1099-LS and Form 1099-SB under Internal Revenue Code Section 605-OY. There's an important exception. When the insured is terminally or chronically ill, the sale may qualify as a viatical settlement, and those proceeds are often federally tax-free under Internal Revenue Code Section 101G. Tax treatment depends on individual circumstances, so anyone weighing a sale should consult a licensed tax professional. If a term policy does not qualify to sell, there are still options: an accelerated death benefit rider, a viatical settlement, or selling a different policy. The first option is an accelerated death benefit rider. Many policies include one, and it lets a terminally or chronically ill insured draw part of the death benefit while still living, without selling the policy at all. The second option is a viatical settlement for an insured who is terminally or chronically ill. It can make a non-convertible term policy sellable even under age 65, and the proceeds are often tax-free. The third option is a different policy. A household may own a permanent policy, such as universal life or guaranteed universal life. That qualifies for sale even when the term policy does not. There is also a fourth honest outcome. If a term policy did its job and covered the years it was meant to cover, letting it expire is a reasonable result, not a failure. Term is built to be temporary. Most term policies are outlived, lapsed, or allowed to expire before any death benefit is paid, which is part of why term costs so much less than permanent coverage. This overview is educational and not financial tax or legal advice. Confirm a conversion deadline with the insurance company and speak with a licensed tax professional about any specific situation.